Hello and welcome. In today's edition of All About Your Company, we're going to be talking about RateGain Travel Technologies. The stock has doubled since the bottom on the 27th of March, and we've seen a stupendous rally on the stock price. In fact, it's doubled over the last 12 months as well. Saw a bit of a dip in March, understandably, at the start of April, and thereafter has just taken off. So we're going to try to contextualize what's playing out. There's also an acquisition at play. Q1 FY27 essentially means better margins, very likely, because integration costs are likely, or rather integration synergies are likely to start getting built in. We'll try and get a perspective of all that's playing out. Let me, though, start off by understanding what the company is about. It was incorporated in 2012, listed in 2021, market cap of around 10,000 crore. It's basically a company which serves hotels, airlines, car rentals, and online travel agencies by providing them with an operating system for hotel revenue, distribution, and marketing. That's broadly the verticals in which it operates. It's a group headed by founder Bhanu Chopra, and we'll speak with the founder and managing director in just a few minutes from now once we're done with giving you the perspective. With regard to products first, it does data as a service, which provides data to travel companies, whether it is airlines or whether it's hotels, in price, demand, and supply. It does distribution, which is pushes services through booking websites and independently as well. And it provides marketing tech, which is it helps acquire customers, social media, run social media campaigns, provide better guest engagement on social media networks and the like, right? So that's how it stacks up. In terms of products, let's quickly take you through it. On the data side, it provides real-time pricing, demand signals, and revenue recommendations. So the first product over there is Navigator. It basically turns complex hotel market data into clear pricing decisions for the hotel. Second is RateGain, which is airlines pricing. That's what it provides, and airlines with a competitive, which allows airlines to price their tickets better. Then there's Rev AI, which is for pricing of car rentals. You have Demand AI, which predicts city-level travel demand from the likes of holidays, peak seasons, and otherwise, how travel demand is really shaping up. In case of a conference as well, it tracks some of those metrics. Then you have Parity AI, Parity Plus, I beg your pardon, which monitors hotel rates which are consistent across a particular region to give hotels a perspective on how they should be pricing their rooms on a particular date at a particular time. Let's also quickly look through the distribution side of things. On the distribution side, it connects hotels to online travel agencies and global distribution systems. So RateGain is the first one. It's basically a channel management software which sends availability, rates, inventory, content to every OTA simultaneously. Then you have Content AI, which cleans and standardizes and distributes hotel descriptions, photos, amenities, and the like. And then there's Smart ARI, which is basically an AI engine which is optimizing availability, rates, inventory updates, all of that in real time. So you've got all of these products. There's Uno RevMax, which is an integrated platform combining booking, channel management, revenue, and marketing. And in fact, all four functions happen on one screen, and therefore that makes it all the more better. You've got Uno Viva, which is an AI voice agent which answers hotel telephone calls and the like, takes bookings, handles reservation queries, and works 24/7. And therefore, that's the other solution which they have. There's marketing technology, which is the third stack which they have. Soho is one of the products there. You've got social media management, which manages the hotel's social media. There's Adara, which is travel intent data. Now, this is an acquisition which RateGain had made in 2023, and it's a US-based company which was acquired, where anonymous data, travel search data, is actually shared with Adara. And therefore, RateGain has access to that data. Very valuable, right? Because it gives you the intent to travel, and that allows RateGain to push out marketing initiatives. And then you have My Hotel Shop, which runs hotel campaigns on Google Hotel Ads, TripAdvisor, Trivago, and the like. There's AI Concierge, which is conversational AI agent for stay-in guests queries and to upsell. So your existing guests also need upselling. That's what this one does, which is AI Concierge. Those are your 4 solutions on the marketing side of things. The business model is simple. It's basically software sold as a subscription, just like, think of it exactly like Microsoft Office, but for the travel industry. And that's what RateGain typically does. There's a monthly or an annual fee linked to it. Alternatively, there's a hybrid model, a fixed cost plus a variable. And then there are fixed cost contracts as well. So it depends on what exactly they're trying to sell and to who. There are customers which add more RateGain products as time goes by. That's really the upsell opportunity to existing customers where they cross-sell their products. Who buys? Well, hotels, evidently so. There's airlines, there is car rental companies, and there are online travel agencies. That's broad brush the customer base. Geography currently present in 24 countries. USA holds around a 54 to 55% share. This is FY25 numbers, by the way, viewers. Europe has around 32% share of top line. So US plus Europe is around 85%. West Asia as well as Asia is approximately 13%, and rest of the world is around 1%. Now, one key development you want to keep in your mind before we go on to the financials. They've bought Sojern, which is an acquisition they've made for $250 million, all cash deal. What the company gets is 13,000 customers globally. North America presence. Sojern is a North American based company. 1,500 crore of revenue, but lower margins. Margins are getting better. Q1 FY27 likely margins will be in line with that of RateGain. They help with travel ads, digital marketing, and demand forecasting. So that's really the service element of it. And that adds to the kind of product base that RateGain already has. Let's talk about the financials now. And in terms of the growth, it's been extremely strong, and you can see that on your screen. You've seen 49% revenue CAGR over the last 4 years or so, but it's been lumpy, right? You look at FY23, FY24 versus FY25, you've not seen that big a growth. FY25 versus 26, you've seen strong growth. So to understand this better, we'll have to track organic versus inorganic growth, and we'll quiz management on that. When you're looking at EBITDA as well, you've seen a consistent scale up. As optimization starts to play out, you're seeing that in the numbers, and you've seen an 80% growth on the EBITDA count. When you're looking at profitability as well, 122% CAGR on profit as a result of the scale efficiencies that are building in. When you look at margins, that will show you the picture with regard to scale and efficiency. Margins which were at sub 9% at one point of time are currently sitting at approximately 18%. Going towards 20 has come off as a result of the acquisition which has happened. Let's look at the balance sheet now. And in the balance sheet, you will see it's the book value is around 2,000 crores, so trades at around 5 times book. When you're looking at the debt, it sits at around 1,000 crore, but it's traditionally a debt-free company. That's something you want to keep note of. The debt has come only because of the acquisition of Sojern. And because of that, you've seen debt go up from 16 crore to 950 crore in the current year. We'll try and understand how the pay down happens. No concerns per se with the balance sheet, and therefore we'll let this go. You look at the cash reserves, they've come off from the 350 crore number to around 170 crore. You look at cash flow, and cash flow largely has been okay. The only worry has been your amortization costs. And because they do these acquisitions, you need to amortize some of the intangibles over a period of time. We'll try and quiz management on that. But nonetheless, otherwise, cash flow, there's no concern per se. When you're looking at return ratios, they've been consistently above 17% 2 years prior to the last year, currently at 14. We're a little bit cautious with regard to that. Of course, prior to that, the numbers were a little lower, and the operating efficiency hadn't fully played out, and therefore, those numbers is not something we've fully considered, but we've shown it to you nonetheless. So neutral with regard to ROCE. When you're looking at shareholding pattern, it's sub 50% on the promoter side. He's had to dilute, of course, and that's understandable. But nonetheless, you've seen decent FI and DI interest. Just look at that interest coming in. And then you've got public with 25% holding. So therefore, we're largely comfortable. 49% promoter holding isn't all that bad. Thumbs up is what we've given this one. When you're looking at valuations, trades at around 31 times 1 year forward. The 2-year average has also been around 31 times, so no concerns there. But the 2-year range has been between 19 and 43 times. So therefore, cautious. We've given this one a neutral. Look at analyst recommendations. 10 buys, no holds, 1 sell. And the return expectations are -2. We've been overcautious here, just given the way in which analyst recommendations are stacked up in terms of return potential, and we've given this a thumbs down. That being said, let me bring on board Mr. Bhanu Chopra, who's founder and managing director at RateGain, to try and understand, one, how travel trends are playing out at this point, and second, of course, what is it that the business holds in store going forward. Great having you here, Mr. Chopra. First off, let me reiterate the guidance you've given. $1 billion by FY30, right? How much of that, just I'm taking a bit of a step back, trying to look at the big picture before I ask you the micros. So $1 billion by FY30, if you do that, that's excellent. But how much of that is organic? How much of that is inorganic? Give us some color.
Yeah, actually, the guidance is for FY31 to be $1 billion, which is about 5 years from now. And if you break it down into a CAGR, it's about 27%. So we think we will grow about 15 to 20% organically, and the balance will come in organically. And I'm happy to state that a couple of times in the past also, when we have made some audacious goals at the time of the IPO, we're about a 350 crore company, which was 5 years ago, and 5 years hence, we're talking about now 3,100 crores. Even in FY24, we had given a guidance of, when we were about closer to about 900 crores, that we'll double the company by FY27 to about 1,800 to 2,000. Again, tracking ahead of that, where FY27 we've guided for 3,000 to 3,100 crores. So feel very confident that we've had a track record of, meeting and beating the estimates that we have given. So I'm hoping we can do the same this time around and reach our goal of 10,000 crores by FY31.
Okay. Inorganic versus organic, would there be any estimate to that? I understand that you've given guidances and you've beaten that, and Mr. Chopra, fully appreciate that. But is there, how should one look at the organic growth versus the inorganic going forward from this point?
Yeah, so as I was stating earlier, the goal to get to $1 billion translates to about 27% growth CAGR for the next 5 years. And if I had to break that 27% growth into organic and inorganic, I think it'll be about 15 to 20% organically, and the balance will come inorganically.
Understood. With regard to Sojern in particular and the acquisition that you've made, it adds around 1,500 crore of top line, that is trailing 12 months, last year's numbers, already for you. So on the 3,100 crore kind of top line guidance that you're giving, 1,500 crore would plus maybe 10 to 15% growth likely would be Sojern, right? Is that the right way to think of it? And if so, how much can Sojern grow by going forward, just on a standalone level?
Yeah, so let me just take a step back and I'll answer your question about the organic growth for this year as well, and get into the specifics about numbers. But I think it's important to step back and also give you a strategic rationale on why Sojern acquisition is such a turning point for RateGain. So, one of our business lines is doing MarTech business, which essentially translates into doing digital marketing for travel industry. And our secret sauce there is the data that we have. This is data that almost 350 different brands contribute to into a pool where we get their search and bookings on their respective websites. So these includes the biggest hotel chains, the biggest OTAs, the airlines. So let's say if you are planning a trip to Singapore and you go on Marriott's website and then you go on Kayak's website, we get all that data and we know that you are intending to travel to Singapore. And there are many such people like you who are intending to travel to Singapore. So we're able to use that cohort of audiences that are planning to go to Singapore in the next 1 month and do very, very precision-based digital marketing. So we have profiles of almost 500 million travelers worldwide, which is our data moat, that we are able to do this precision-based marketing. And that is our differentiator when we go against the large ad agencies for these big, travel companies. So I'm happy to report we work with now some of the biggest names, and we are the only company in the world that has this, data moat, the secret sauce of databases, which we are able to do this precision-based marketing for our customers. Now, going back to the numbers, so for this year, we've guided for 3,100 crores, and I'm happy to state that basis the Q1 trends, our revenue growth is seeming higher than that, as well as we guided for margins of about 21% for this year. That should look even better as well. On a combined basis, because we were able to bring together the Sojern platform with all the digital marketing that we were doing through Adara as well. The combination of the platform has driven a lot of cost synergies, as well as, like I said, now Adara and Sojern were number one and number two players in this field. We've been able to bring it together, and there's no other player now that comes to the scale that we have anywhere close. And as a result of which, we should see acceleration and organic growth as well. And in our guidance, we were very clear that our organic growth for this year would be between 12 to 15%. And so an overall growth would be about 70%, and the balance being as a result of the inorganic growth through the acquisition that we just did. So I feel that there will be an acceleration of that growth given the dominant position that we have in the marketplace. And I'm very, very excited about the future. I think the next 5 years are transformative years for RateGain, both on revenue growth as well as EBITDA margin expansion.
Understood. With regard to NRR, that's been one of the vital turning points in Q4. It fell below 100%. Is that at all a concern, and how quickly do you unwind that?
Yeah, so yes, that is obviously something that we need to improve on, and it should improve on from here on. And just for your audiences, NRR is really the concept of getting a sense on how much we are growing with existing customers. So in SaaS, 110 is a very, very good number, which we were at historically. Last couple of years in our distribution line of business, we have had some large customers that had a decline because we basically bill hotels, and there were a couple of large OTA players that basically sunset as part of the big OTA strategy. And we saw a decline in a couple of large customers' business, which kind of dented that NRR. But we are on our way to recover on that, and we have a great expansion strategy. In fact, that's the whole thesis of RateGain. We work with all the top 400 hotel chains, all the top car rental companies. In your introduction about RateGain, you didn't cover about destination management companies, which are tourism boards. They're a big part of our business. They're almost 1/3. So just to give you a sense, like, Incredible India, Visit Dubai, Visit Abu Dhabi. We are very dominant with all the tourism boards in the US, and we're seeing some significant traction with that business with the tourism boards in the US because of FIFA and how they're looking to, attract tourists and spending power. So we've seen a great traction in the growth that we are seeing with these destination management companies. And basically what we do for them is also digital marketing, where we are able to attract tourists to that particular destination through our digital marketing efforts.
Right. Mr. Chopra, I'm going to have to pause the conversation here, take a mandatory commercial, come back, continue that conversation. How is AI disrupting the business? What's keeping him confident that NRR which is net revenue retention, technically speaking, recovers. So net revenue retention is nothing but the current client base and the revenue coming in addition to that. So if it's sub 100, you see a bit of a degrowth on the current client base. That's what he was just explaining to us. We'll come back with a couple of those questions, of course, and take a long-term view as to what's driving margins higher, how much higher can they go. Welcome back. We're in conversation with Mr. Bhanu Chopra, who's the founder and managing director at RateGain Travel Technologies, to talk to us about how the future or what the future has in store. Mr. Chopra, talking about AI, you've spoken on earlier calls that AI is in fact an accelerator to adoption of your technology. What keeps you comfortable that all the verticals, not just one, all the verticals within RateGain continue to remain insulated from the AI challenge?
Yeah, so I think we've been at the forefront of utilizing AI both internally and also launching AI solutions. And I'll just quickly give you a 1-minute peek into everything that we are doing inside of RateGain. So we are seeing huge productivity gains as a result of adoption of AI. Of course, our engineering output and throughput has exceeded multifold as a result of AI adoption. We have Remo, our first HR AI agent. We are utilizing, across all functions, AI to automate faster. And as a result, we're seeing huge productivity gains. Our overall costs of doing business is coming down, both from people side as well as the software tools that we are using, because we are able to replace them. From a perspective of what we have launched in the market, as I noted earlier in the earlier commentary about how we are very big into digital marketing, we're now using AI ads to get scale into how we experiment and A/B test different kinds of personalization of sending the right ad, the right message to the right consumer, again, with the objective of improving the return on ad spend on all the digital marketing dollars that our customers spend with us. On our new initiatives and new products, I'm very excited about our Uno Viva AI agent. It's basically an AI agent that processes voice calls on behalf of our customer. And it's a real problem in our industry because there is shortage of labor. It's difficult to train them. There is high turnover. And if you go into emerging economies, for instance, we signed somebody in South Africa recently. And the problem is you don't have trained staff that can speak in multiple languages, because there is a lot of tourism into South Africa, for instance, from Europe, and even speak their own language like Afrikaans. So I'm just using that as an example, but there are many such use cases that we see across different continents, and having AI agents be able to amplify and also process bookings on behalf of the hotel. We have an AI concierge products that's almost like a WhatsApp assistant that's with you at every part of your traveler's journey to be able to help you book restaurants, to book tourist attractions, etc., that we empower on hotels' behalf. So there's many such AI initiatives across all our 3 different lines of businesses on MarTech, distribution, and DaaS that we are very, very excited about and seeing good traction.
Right. And Mr. Chopra, you suggested that 1 or 2 OTA clients have actually gone off stream. What's the risk of more such, or what's the likelihood of more such clients leaving or closing their contracts out? And what's the duration of the contracts that you have? So what's the visibility like? And why is it that they have left? Could you give us some color on that?
Yeah, so, these are not situations that were a result of anything to do with AI. It was largely, if you look at the OTA space, it's dominated by three or four top online travel agents such as Expedia, Booking, Agoda, and Trip.com. And in this case, in this particular case, one of these big OTAs has multiple subsidiary brands, and they decided to converge on one brand, and as a result of which they sunset, a couple of subsidiary brands that they had. So it was an overall corporate strategy to sunset other brands, which resulted in some decline in our business because we had association with one of these brands that were sunset. In terms of your other question about our contracts are usually yearly contracts, but they renew every year, and they're perpetual in nature unless we are given a notice. They usually continue to renew. And if you look at our GRR, which is our gross retention, it's upwards of 90%, which is very, very healthy for any SaaS company.
Mr. Chopra, if I've done the math right again, so you'll do 3,100 crore plus in terms of revenue FY27, you'll do 21% margins, which takes you to around 650 crore or 620 or 630 crore in terms of EBITDA. If I remove the interest cost of around 75 to 80 crore, that leaves you with 550 crore cash, right? What do you do with that? Of course, taxes, etc. apart. What do you do with that kind of cash? Do you repay your debt of 1,000 crore? What's the capital allocation strategy going forward?
Yeah, so I'm happy to report we are actually trending much higher than our guidance of 650 to 700 crores EBITDA. I think we should beat that by a comfortable margin. On your question on how do we utilize the cash? So look, our strategy right now is to continue to pare down the debt. Our debt is close to about 900 crores at this point. Our net debt situation is about 700 crores because we have about 200 plus crores on our balance sheet. And our strategy is to continue to pare down the debt unless we have additional M&A opportunities. And our intent is to pare down the debt by FY28. I feel fairly confident given the additional cost synergies we're seeing in the business, additional operating leverage we are seeing in the business. I feel comfortably that we will beat our guidance of even the 21-22% margin. So we will continue to pay down debt unless M&A opportunities appear. And I'm also happy to report we are talking to some companies as well. But as you have noted in our past 4-5 year history, we are very disciplined around M&A and very judicious capital allocators. So we'll consider those opportunities on a case-to-case basis on the strategic rationale and it continuing to hold our thresholds around IRR and payback periods of 5 years.
All right, Mr. Chopra, thank you so much for joining us, giving us that color, that perspective. More acquisitions, that kind of stood out because there could be more in the pipeline in terms of inorganic growth. Completely timed out on this edition of All About Your Company. Thanks, viewers, for tuning in.